thanks to all of you for joining today for this conversation entitled Investing in a Volatile Market. As Debbie said, my name is Sandy Horner. I'm a managing director with Baltimore-Washington Financial Advisors, or BWFA. We're based out in Columbia, Maryland. For those of you that know the area, we're right next to Toby's Dinner Theater off of Route 29. Later on, towards the end of our time together today, I'll share just a little bit more about our firm with you in case you're interested in chatting with us. But today we're going to jump right into talking about investing in a volatile market. I did get a couple of questions, and so I have a question here from Michael, so I will take that in a little while. And Michael was concerned about the slipping value in his 401k, so we're going to talk a lot about that. We're also going to talk about the market in general and inflation and give you some historical perspectives and some tools for how you can try to sleep well and not panic in this volatile market. And I recognize while I say that, so like it's nothing, it's hard to watch your 401k or your IRA or your investment account or whatever it might be, your money that you've worked so hard to invest, it's hard to see it go down in value. And so I'm going to ask you a question about how you feel about volatility and how does volatility actually make you feel? And let me tell you a sort of brief story about volatility while you're thinking about your answer to this, which is that if you're walking down the street, right, let's say after this webinar, you decide to go out and grab some lunch quickly and you're walking wherever you may be, whether it's Baltimore or somewhere else, and you see a $20 bill lying on the sidewalk and you say, wow, look at that, cool. And you look around, you don't see anybody else. It's obvious that nobody just dropped it. It's been sitting there. And so you pick it up and you have some good luck. You found a $20 bill that day. You stick it in your pocket and you go on about your business. When you get home at the end of the day, you may be changing your clothes. And as you go to take off your work clothes, you reach in for that $20 bill. And all of a sudden now, for some reason, you can't find it. And it's gone. It's missing. Well, the reality of that story for 99.9% of people is the pain you experienced when you couldn't find the $20 bill anymore is greater than the joy that you experienced when you found the $20 bill. And so the conflict is that people take the volatility in the market much harder to the downside than they do to the upside. And that's what I want to start you with. Never forget that volatility is how we make money in the market. I say we, investors, you and me, and everybody else that invests. Think about it. If the market was flatline, if it never moved, how would you make money? The way you make money is to buy something at a lower price than you ultimately sell it for. So I get that it probably makes you nervous and anxious, but remember, it's also what helps you build wealth. And, you know, it's interesting when you look at the media as it relates to volatility. You know, it's kind of like that old line you've heard people say over the years, you know, they don't report on planes that land safely, only the ones that crash. Right? Or that other adage you've heard people say, you know, it's kind of like a car accident. You're driving around the Beltway, you see a car accident. It's almost hard not to look at the car accident. Well, clearly, if you look at this chart that I have on the screen in front of you right now, you will notice that the red line is Google searches for CNBC, a purveyor of financial news, CNBC. You'll notice that the blue line is the S&P 500, the Standard & Poor's 500 index. And what you can see is that the spikes in Googling CNBC, or the number of people online looking for financial information, is considerably greater in down markets than it is in up markets. It's kind of like when your 401k or your 403b is going up, you don't really think about it. Like, okay, it's doing well, I don't have to worry about it. But then why do we worry so much about it when the market is going down? Because in actuality, for the vast majority of us, what is going on in the market right now, if you're retiring 10, 15, 20, 25 years down the road, it has very little impact. If anything, it's an awesome buying opportunity. And we'll talk a little bit more about that. And for all of you who are, 5 years away or less, or even less than 10 years away from retirement, well, then this takes on a little bit of a different meaning. And we need to put some tools in our retirement toolbox to make sure that we're going to be prepared for when we want to retire. Sentiment regarding the market shifts on a dime. And if you look at this, you can see when the horizontal bars, as represented by the red, that is bearish. So those are people that are feeling negative about the market. The green, positive or bullish, right? People that are feeling good about the market. The gray is neutral. And what is so interesting to me is that if you look at this historical perspective on market sentiment, and it takes you from late December 2021 until just a few weeks later in late January 2022, and you can see that the number of people feeling good almost cut in half, the number of people feeling bad about the market, not quite double, but certainly 50% greater in just a matter of a few weeks. And how does that relate to our investments? And so, again, many of these slides that I'm sharing with you right now, we're going to look at another one, are how people react to the market and the emotional aspect of investing. I kind of just wanted to get that out on the table and talk about it a little bit, because it is reality that people are like this. So, which emotion drove you to buy or sell? Fear, hope, greed? I hope that it was none of these emotions that drove you to buy or sell anything, to be perfectly honest with you, because you don't want to be emotional about investing. We work, as you may know, with lots of different people from Hopkins. We work with a lot of really smart rocket scientists from the Applied Physics Lab out here in Howard County. And I've had many a very intelligent person from APL look at me and say, I'm good at a lot of this, but I can't pull the emotion out of the decision-making process when it's my own money, which is why I want to work with you, because then you will take care of that for me. So notice on this chart that where there is the greatest excitement or thrill or euphoria in terms of the emotion is also where you have the greatest risk. So if you look at the upper left-hand corner of this slide and you see the word risk in red font, that is where so many people often tend to want to get into the market, because they get caught up in the excitement. They hear their friends and family members who are doing well in their 401k or their 403b, or they bought, some investment that went up, whether it be Netflix or Amazon or whatever, Microsoft. And they say, I want a piece of that action. And then they get in, and what happens? Well, the market goes down. Now, we know the market goes up. We know the market goes down. And we're going to talk in a few minutes a lot about those cycles. So more on that in a moment. But we also know that right now, for example, most things are 30% cheaper than they were 6 months ago. So why is it that so few people want to invest? everything just got 30% cheaper. If I told you, hey, I don't, what's your favorite store? Dick's Sporting Goods, Nordstrom's, the Apple Store, I don't know, wherever you like to shop. If I told you everything was, 25 to 50% off at your favorite store, you would be rushing to go there and capture a good deal on some of the bargains for the things that you like so much that they sell at that particular store that were 25 to 50% off. Well, that's kind of where we're at in the market right now, is that most things are 20 to 40% off. 40 is a little extreme. There aren't too many things that are that much off. Certainly, I know in our investments that we work with. But let me ask you a question. If you lived in your house for 5 years, 10 years, 20 years, or 5 days, 10 days, or 20 days, I don't care. You live in your house, and all of a sudden you get a leak in the roof. Do you get rid of the house? Do you sell it because it's not good anymore? No, of course not. You patch the roof. Well, why is it that the sort of immediate knee-jerk reaction for so many people when the market goes down is, I'm going to sell my investments. I'm going to get out of the market. Do you really think the companies that you were investing in before this market down cycle, are they no longer viable investments? I mean, if the real answer to that is yes, I no longer believe they're viable investments, then okay, maybe you should sell them. But when and I'm not recommending these companies, I'm just using them as examples. You've all heard of them. When you look at Microsoft, when you look at Amazon, when you look at Google, or now Alphabet, Facebook or Meta, you look at these companies, are they going out of business? No. Are they down 30%? Yes. Is it possible that represents a good buying opportunity? Absolutely, it's possible. Now, I want to be very clear with all of you, and you've probably heard this before, but past performance is no guarantee of future results, all right? And you'll see some disclaimers on some of these slides that say that. So I just want to go on the record as saying that. Just because it happened in the past doesn't mean it's going to happen in the future. I would also tell you that I find 4 of the most dangerous words in investing to be, this time it's different. There are a lot of people that will say, oh, well, this time it's different. It's not going to be like the last time we saw the market go down. I think those are, I urge you to use caution if somebody says this time it's different. I'll just leave it at that. So a couple things for you. Number one, we're looking at the last 13 years of performance, right? So this goes all the way back to 2008. And as you can see from this slide, the S&P 500 has returned 600% in the past 13 years. So even if you gave up 50% of that, you're still over a longer period of time looking at an incredible amount of upside or positive performance. So it's not like we're coming from a place of dread. We're coming from a place where the market has been doing phenomenally well for pretty much all of the last 13 years, at least 12 of the last 13 years. You can see on this chart, 2018, the market finished down a little bit, not a lot, down, a few percent, or down 4%. So other than that, the market has had pretty darn good years most of the time. And I also want to remind you, and I know there's a lot of information on this chart. Hopefully, if you see some things in here that you want to look at a little bit more slowly, take your time with it, be a little more methodical about studying all the data on it, you'll be able to go to the recorded version of this webinar, and you can pause and stop and look at things in a little bit more relaxed version. But for the purposes of our conversation today, we need to keep moving ahead. But if you look at this over the last 21 years, you see going back to 2000, that virtually every single year, there is some pullback in the market. And in fact, more than half of those years, there have been pullbacks of 10% or more. This is for the S&P 500. So if you're not 100% clear what I'm saying here when I reference a pullback, let me spell this out for you. So I'm going to go all the way over to the far left side of this chart and just make it super simple. We'll start in the first vertical pair. That is the year 2000. In the year 2000, the market closed down 9%, right? That's in the blue bar, down 9%. But at one point, as the yellow bar shows you, the market was actually down 17%. So now let me give you an example where there's a positive rate of return, because that's really what I want you to think about a little bit more. So move over a few years till you get to 2003. And then, as you can see in the blue bar, top half of the page, in 2003, the market closed, as measured by the S&P 500, up almost 30%, up 29%. But at a given point during 2003, the market was actually down 14%. So again, you can look through all of these years. There's a very strong likelihood that you have to have patience through the bad days, weeks, months in order to get the good return ultimately that will come in more years than not. More on that in a minute. And then again, a lot of performance information here, but I wanted to share with you a lot of different data. I know people look at data different ways. Here's a really simple way to look at it. This is the S&P 500 index rate of returns, daily, weekly, monthly, quarterly, annually, along with how often you see negative rates of return. So you can see, as measured by the S&P, 46% of the daily returns are negative, or it's almost a toss-up, right? Any given day, the market could be up or down. A little bit more positive on the week. As you can see, 42% of the weeks are negative. But as you start to even just go to the months, only 34, about a third of the months are down. That means 2/3 of them are up. Quarters, 27%, and annually, 19%. Or in other words, 81% of the time, the S&P provides a positive rate of return annually. Only 19% of the time is it negative on the annual basis. And then again, just looking at it one more time, and then I'm going to show you another slide about bear markets, and then we're about to move into some different topics in a moment. But here's the same information, just displayed a little bit differently. All right, 81% of all one-year periods positive on the S&P since 1970. 85% of 3 years, 90% of 5-year periods, 95% of 10-year periods, and 100% of all 20-year periods. So this is like 70 to 90, 71 to 91, 72 to 92. So that's a lot of 20-year periods. Every single one of them was positive. So go back to that remark that I made 10 or 15 minutes ago when we started, that if you're 10 plus years away from retirement, you really should not be losing a lot of sleep about what's going on in the market right now. Now, you may be very well losing sleep, but you really shouldn't be, statistically speaking. All right, couple more slides on here. I see Sandra has a question that I'm going to look at in a minute. So bear markets are common. So again, here are S&P 500 declines of 20% or more from 1929 through last year. And as you can see, there have been a whole bunch of them. So the point that I'm trying to make to you in sharing all of these statistics with you, and I realize they can be somewhat troubling, especially in a webinar, but statistically speaking, we know the market goes up, we know the market goes down, we know that corrections happen on a regular basis. You can see they're quite common here. If you go to the very bottom of this chart, you will see that the average decline is 35.62%, kind of about where we are. And you can see that the average length of that decline is 289 days. And so one could make the argument, I don't have a crystal ball, so I don't know for sure, but one could make the argument that we are closer to the bottom of this market than we are to the top, which is a good thing, which would mean that we're pushing through it. Now, do I think that we are headed to rosier days? No, I'm not going to be Pollyannish with you. I don't think 2022 is going to be a year for the record books. But I'm going to share some data with you coming up in just a few minutes that will also suggest that I don't think, making a wholesale change in the way you're invested in your 403B or your 401k or any investment structure for that matter is in most people's best interest. I'm not suggesting that you may not want to fine tune a little bit, but a wholesale change, probably not for most people. Okay, and then here are some specifics on 4 companies that you've all heard of, right? So you're all familiar with Microsoft, Amazon, Alphabet. By the way, if you don't know, Alphabet is Google, right? Same company. And then Netflix. And I mean, I know Netflix has pulled back recently, and this is just through the end of 2021, but don't get caught up in the details. Look at what I'm showing you here. The cumulative return on Netflix since 2007 at the end of 2021 was over 16,000%. And you can see Microsoft, Amazon, and Alphabet have done pretty darn well too. And you can see that in that, roughly 14-year time frame, they had corrections of being down more than 10% multiple times, 14 times for Microsoft, 22 times for Amazon, 12 times for Alphabet, 32 times for Netflix. And the returns per year, again, 20, 34, 18, 40%. So again, yeah, some things are changing for Netflix, but, let's talk about Microsoft, Amazon, and Alphabet. Have these business models just changed overnight and they're no longer relevant? Are you no longer working with Microsoft software? Do you no longer shop on Amazon? How many times have you Googled something, in the last week? Most of us are still using all these companies. I know I've got 3 kids at home that are all watching Netflix all the time. And sure, that platform's changing and it might be costing my family a little bit more. And, maybe we go to the commercial version to save a few bucks. I don't know. We haven't crossed that bridge yet. But my point being is that these companies are fundamentally sound. It's just the market that's driving them down. Okay, Sandra asks, when the market is dipping and you are at retirement age, it is disturbing because we don't have all the many years to wait for our loss in money to come back. And I would agree with that wholeheartedly, Sandra. You're absolutely correct, which is why it's so important for folks that are close to retirement age. And I'm going to define close to as certainly under 5 years, maybe even anything under 10 years, that you need to be preparing for retirement, which means you need to have some assets in a non-market correlated asset. So like you need some money, Sandra, that's not in stocks. So that if the stock market is down 30% when you need that money to pay your mortgage or take a trip or spoil your grandkids if you have them, you get the idea. In retirement, you don't have to worry about what the market is doing. And generally speaking, when we work with folks, that's one of many different steps that we are taking as a way to mitigate risk for retirees. There are many other things that can be done as well. So why am I talking to you about all this long-term performance type information? Because the next 3 slides are going to provide you, in my humble opinion, with some of the most important information that I'm going to give you in our hour together today as it pertains to investing. And so the first thing that I want you to do is I want you to look at this 10-day segment of investing as measured by the Dow Jones Industrial Average. And this is February of 2020. So this is when the pandemic was at its, at its most shocking levels for many of us, right? This is right about the time that quarantine, isolation, many of us were moving to a virtual work environment. And these are the actual returns of the Dow Jones Industrial Average in that time period. And you can see that it goes February 24, 25, 26, 27, 28. That was 1 week. So the market was down 1,000 points. The next day, it's down almost 900 points. The next day, it's down 124 points. And we thought we were living large. We're only down 124 points. The very next day, it's down almost 1,200 points. And then the very next day, it's down 350 points. And I say we, all of us are thinking, oh my goodness, what is going on here? But we made it through the weekend. We woke up on Monday. The market opened up and it closed Monday, March 2nd, up almost 1,300 points. Now, sure, it was down 786 points the next day, but then the very next day, it was up another 1,173 points. And it was down a little bit the 2 following days. But this chart does a phenomenal job of showing you what I'm trying, the concept that I'm trying to instill in you in the next 5 minutes about not trying to time the market. It's so important. Because look at this chart for just one more second before we move on to the next one. Think about that. Think about if on Friday afternoon, when you saw this down for the 5th day in a row, you said, I'm done. I throw in the towel, sell, I'm out. And then Monday morning, the market's up almost 1,300 points and you don't participate in any of it because you got out of the market. And some of you might be saying, yeah, I did that. Some of you might be saying, oh, I would never do that. Well, I will tell you, we saw lots of people doing that. Not our clients, but the reason why we know lots of people did that is because they came to us in June, July, August, September, when for large part the market had gone right back up. And they said, hey, you know what? In March, I was down 25% and I pulled the plug. I sold everything. I went to cash. And now it's July or August. I'm still down 25%, but I see the market's gone back up, but I am still down 25%. Well, yeah, because you took your money out of the market. So don't try to time the market. And again, a little more statistics. This is a financial presentation after all. But if you look at this chart, again, what we're trying to show you here is that when you miss the best days in the market, you severely, severely hamper your ability to make money. So if you invested $10,000 from 1991 to the end of 2021, $10,000 in the S&P 500, just put it in, let it ride, never touch it, never do anything. At the end of that time frame, you have $208,000. However, if you had missed just 10 of the best days, now keeping in mind, we're talking about a 30-year window of time, and you're missing just 10 days, you cut your return by 54%. And now you only have $95,000. And if you missed 30 of the best days, go all the way over to the far right-hand corner, now you've lost 83% of your return. So you can see being in the market on those best days is critically important. Otherwise, you will not achieve a rate of return to your liking. And the last slide I have for you, here's the really hard part. You thought this was hard. Wait till you see the next slide. Here's the hard part. Half, 50% of those best days occur during the bear market. So this pie chart represents the same time period, 1991 to 2021, the same index, the S&P 500. Now I'm measuring the 50 best days, and what you can see is that 50% of them, or 25 of those days, occurred during the bear market, just like that slide shows. Some of the best days happened when the market was actually going down. And you can see that 28% of them occurred during the first 2 months or 60 days of a bull market. 22% happened during the rest of a bull market. So in other words, ladies and gentlemen, about 3/4 of the best days that you're going to experience as an investor actually occur during the bear market or in the very early stages of a bull market, when you are probably still wondering, is it safe to go back in yet? So be careful. And for those folks that do pull out, they often go to cash. And while there is a time and a place for everybody to hold cash, and I am brought to you by Baltimore-Washington Financial Advisors' longtime standing partnership with the Johns Hopkins Federal Credit Union. So I am not discouraging anybody from having cash, but you should have appropriate levels of cash, and you should hold cash for the right reasons. You shouldn't typically have a whole ton, like 25, 50, 75, 80, 100% of your investments in cash because you're scared of the market, right? That's not really going to be a satisfactory approach. And if you look at 2020 and you saw so many people get nervous and go to cash, they actually lost money because cash was paying less than 0.5%. Inflation was running at almost 2%. And as you can see in the middle of your slide there towards the bottom half, your net return on cash was down about 1.4%. Versus if you had a conservative, broad-based investment portfolio, your net return was about 7.8%. So be very, very cautious. Now, you may or may not be ready to add to your investments right now during market volatility, but I will tell you right now, this chart shows you how you would fare if you just made no changes, buy and hold. If you actually moved to cash when the market experienced significant volatility, or if you actually made additional investments when the market experienced significant downside volatility. And as you can see, the optimistic investor at over 2 million is substantially better than the buy and hold approach of 1.3 million, and considerably better than the apprehensive investor who moved to cash at 600,000. So again, be careful of moving around and making the decisions that you want to make. So we're in another dilemma that I want to talk to you about, and we're going to shift gear and talk about bonds for a couple of minutes here. Many of you probably don't realize, but if you're in your early 60s or younger, you in all likelihood have never experienced a bear bond market. That is to say, a bond market where people lose money owning bonds. And let me quantify exactly what I mean when I say that. So another common perception amongst investors out there is, oh, when things get risky in the stock market, I should buy more bonds because that will act as a counterbalance to the volatility of the market. Sometimes that's true. Sometimes that's not so true. Now, while we always advocate for diversification, be careful right now about diversifying with bonds, and especially long-term bonds. And let me explain why. If you look at the chart on the screen right now, simply put, and yes, there's some spikes and some peaks and valleys and it goes up and down, but simply put, interest rates since the early 1980s have pretty much been coming down on this chart as measured by the 30-year Treasury since the 1980s. So in other words, since I was in college, interest rates have been coming down, not up for the most part. Why is that important? Well, because if you're not aware of this, interest rates and the value of bonds or bond prices move in opposite directions. So in other words, if you're looking at the left side of this chart, as interest rates go up, something that is occurring right now, bond prices actually come down. And if you think about it for a minute, it makes perfect sense. It's not that complicated, right? If I can go out and buy a 5% bond today, why would I want your 4% bond from last year or your 3% bond from 2 years ago? So your bond, as interest rates rise, actually becomes worth less because people can go out and replace it with new bonds that are paying more. It's just like the same thing occurs in the opposite direction when interest rates are falling. Because when interest rates are coming down and new bonds are being issued at a lower interest rate than maybe the bond you own, then your bond becomes more valuable because people say, oh, you have one of those 5% bonds. I'll pay extra to get that because today I can only buy a 4% bond. Now, that's a very simplistic description of the bond market, but it is an accurate description. And so if you just moved a whole bunch of money out of the stock market and into the bond market and interest rates continue to go up, which we think they probably will, most of Wall Street agrees that they will, then you may be in for a little bit more pain than you bargained for, especially if you pulled out of stocks and you went to bonds thinking that you were going to be more conservative and less exposed to risk. Now, I should also point out to you that this risk is even more exacerbated when you own bond mutual funds as opposed to individual bonds. So if you own individual bonds, you have a little bit of insulation from this loss because you will ultimately get your money back from that bond. However, in a mutual fund, bond fund, it's a very different situation. So you want to be cautious about moving into bonds haphazardly right now without really thinking it through. Now, of course, I don't have to talk to you about inflation because you all know about inflation, but let's just kind of talk about inflation for a few minutes. So yes, inflation is running rampant right now. We're looking at prices that are substantially higher from where they were just 20, 30 years ago today. Gasoline up almost 50%, used cars up 37%. Utility gas up 30%, new cars, trucks up almost 12%, meat, poultry, fish, eggs up 12.5%. let's look at this chart. It's a little bit easier to look at. You're buying groceries today. It's $50 for what you pay at the grocery store for the bag of groceries that you need. Well, if inflation runs at a 3% level, which is pretty normal, that means that same bag of groceries in 30 years from now is going to cost $122. So let's talk about Sandra's question, right? Sandra asked me about the volatility in the market, and I believe, if I remember correctly, she was a retiree, and she was worried about the fact that she doesn't have years ahead of her to make up any loss that she might experience in value of her investments. And that is an understandable concern. The other dilemma that Sandra has is, let's say she's retiring, or any retiree is retiring now around mid-60s in good health, and you live to your mid-90s. Well, that $50 bag of groceries is going to cost you $122 before you're leaving planet Earth. And so how do you make sure that you not only can pay for your groceries today, but you're going to have twice as much, even more than twice as much money in 30 years so that you can afford your groceries when they're $122? And what if inflation continues to run at higher levels than 3, and you can see at 5%, that $50 bag of groceries is going to cost me $216. So you have to prepare. Again, more tools in the toolbox of your retirement toolkit to make sure that you're well funded for the future. Oftentimes during a conversation like this, I get questions about gold, right? Shouldn't I buy some precious metals? I think the people making the most money in precious metals are the actors on TV who are selling precious metals. But I put this chart in here just for any of you that are leaning towards precious metals. So back in 1979, yes, remember the Jimmy Carter years, inflation was also running at about 10%. All right, I realize it's not at 10%. I said also, but running at about 10%. Not too far off from where we are right now. So here are 5 reactions to 10% inflation in 1979, each of them with an initial investment of $10,000. So the equity investor says, I'm committed to the stock market. I've got, 30, 40, 50 years to go. I'm going to stay in the market. I put my $10,000 in stocks, and 41 years later, they have 1.5 million. The balanced investor says, I don't know whether stocks are going to do better or bonds, and so I'm just going to split it between the two. That original $10,000 investment, again, roughly, as you can see, 40 years later is worth $633,000. The bond investor who said, I'm scared of stocks, I'm just going to go straight bonds, they have $192,000. So let me skip the gold for a second. If you had just had cash, 30-day T-bills, for that same time period, your initial $10,000 grows to $57,000, okay? Gold, $63,000, just a little bit better than cash. And not even in the same league as stocks, or frankly, even just bonds. So for those of you that are seeing the ads on TV about how now is the time to put gold or silver in your IRA, think twice about that. Because if you did that back in 1979, you literally barely made any more than you would if you just left your money in cash. So just a couple of other quick comments as we start to move towards the end of our time together. We do have some other issues that are out in front of us. So let's talk about them. One is coronavirus hasn't disappeared. But again, historically speaking, when you look at various epidemics and how they've impacted the market, there is no evidence that we should be freaking out about the remnants of COVID-19 as it pertains to our portfolios. Absolutely, it's concerning. People get sick. Obviously, way too many people have passed away. But as it relates to our investment portfolio, there's no discernible evidence in looking at history anyway that we should, be doing something considerably different than what we were doing pre-COVID, post-COVID, because it will likely not have a long-term impact. Certainly COVID, among other things, has interrupted the supply chain, and that certainly is an issue, and it's not going away. I'm just going to tap on some of these quickly. There's also, evidence that in an election year, the volatility does spike as well. So you got that going for you, right? So you have this volatile market. You have an economy that was pumped up on $10 trillion worth of cash that the government injected into it to get us through the, COVID situation. And, you can argue if that was wrong or right. At this point, it's water under the bridge. And now we're dealing with the consequences of that. Yet we still have to deal with COVID. We still have to deal with supply chain issues. We still have the reality that in midterm election years, the market tends to be a little bit more volatile. We have Ukraine and Russia, dare I say. We haven't even talked about them. But again, we don't have a lot of statistical evidence, historically looking, that geopolitical conflicts have had a major impact on investing. And, certainly what is going on in Ukraine right now is horrible. But again, like I mentioned about COVID, as it's relevant to your investment portfolio, not as big a deal as you might think it could be. And, keep in mind that there are always reasons not to invest, literally. I mean, if you don't ever want to put another penny in the stock market, I promise you, you can find a reason every single day to convince yourself that now is not the right time to invest. But put some of the slides I've shared with you in the last 60 minutes in perspective. And we know that over time, the market goes up more than it goes down. We know that the market corrects periodically. This is not a unique situation. It happens, and we have to deal with it. And then just look, going back to 1972, Watergate, Vietnam, high inflation we had before, Middle East, LA riots, invasion of Afghanistan, Iraq war resolution, presidential impeachment, pandemic, Omicron variant, political dysfunction, you name it. There's always a reason not to invest. So you want to be cautious about that. All right. So let me wrap up. And then I have a question here from Michael I'm going to answer that he sent in ahead of time. And I relish the opportunity to answer any additional questions you might have. Feel free to type them in. I'm in the home stretch here. We will definitely conclude by around 1 o'clock. I think we might have had this scheduled till 1:15. So if there are a lot of questions, I'm happy to stay longer, but I did want to let you know we're in the home stretch. I do a lot of these webinars, like literally almost a couple hundred a year. And I recognize an hour is about what most people have to stay on a Zoom meeting. So I'm cognizant and respectful of that. And I do appreciate you all being here for an hour. So, I can't control the market. You can't control the market. I don't know whether it's going up tomorrow or down tomorrow, but I do know, based on a lot of statistical evidence, much of which I just shared with you, that over longer periods of time, as investors, we tend to be well rewarded for investing in stocks and not as well rewarded for investing in bonds or other securities. And so for me, I choose to have a diversified portfolio that utilizes a high percentage of my own investments into the stock market. And I'm comfortable with that. But you need to be comfortable with whatever your strategy is. My suggestion to you is that you have a plan. Don't try to wing it. My advice to you is that you have an investment strategy. Again, You don't try to wing it. You ought to have a tax strategy. And if all of you, or any of you, I should say more appropriately, are looking at those things saying, well, I'm not exactly sure what he means by a financial plan. When I say financial plan, I mean like a roadmap that says, hey, I'm 45 today, and at my current rate of saving, I'll be able to retire when I'm 65, and I'll be able to spend $115,000 a year every year in retirement. I'll get to increase that each year to cover the rising cost of inflation. And based on those numbers, I will never run out of money. Now, a financial plan covers a lot more than that. And by the way, those numbers weren't for me or for you or for anybody. I'm just making them up, but you get the idea. A plan talks to you about how you will address all the facets of retirement: Social Security, health care, life insurance, long-term care, whatever it might be, and how much you can spend every year and never run out of money. An investment strategy should be specifically built in conjunction with your plan so that you achieve that goal, whatever that goal might be: retirement at 65, or maybe you want to retire earlier. A tax strategy is just an intentional way to minimize your tax liability. And then have your legal documents in order and up to date. And what I mean by that are wills, trusts, advanced medical directives, powers of attorneys. These are all things, if, I'm sorry, but hey, if you're over 30 years old, you ought to have these things. And don't assume just because, you're 35 and you happen to be single that if something happens to you that mom and dad could just step in and take care of it. They can't. They may be your mom and dad, but they're not legally allowed to do anything for you. You're your own adult unless you set up legal mechanisms, estate planning documents to allow them to do that. And then, of course, if you're married, and especially if you have minor kids, then it becomes even more complicated. And many of you may be on this webinar today because you were looking for a source of information, education, because you're doing a lot of this work on your own. That's great. I'm thrilled to have you here, and thanks again for coming. But I will tell you, start building a relationship with an advisor, because there will come a time, based on my 35 years of experience, when you will need to look to somebody for some help. You will run into something that is outside your scope of expertise or abilities. And that's typically not when you want to start looking for an advisor. That's when you want to be able to pick up the phone and say, hey, Sandy, I know, we don't do a lot of work with you, but you know who I am. I have a problem. I need your help. And if you find yourself in that position, I hope that you might consider a conversation with Baltimore-Washington financial advisors. And this is my closing slide. Again, I remind all of you that if you have some questions, I'd be happy to take them, and then I will answer my questions and we'll wrap up here. I've got 12:55. BWFA is a fee-only fiduciary advisor. So if you're not familiar with that, it means we're not brokers. We don't sell products. We don't charge commissions. As a fiduciary, we're obligated to always put our clients' best interest first at all times. By the way, just so you know, whether you're talking to somebody at Transamerica, Merrill Lynch, Morgan Stanley, Fidelity, Vanguard, wherever, they're more likely than not, they're probably not a fiduciary, which means they have no legal obligation to do what is best for you. So if you're looking for professional financial advice, make sure you're talking to a fiduciary. It's the only type of advisor who is legally obligated to provide you advice that is always in your best interest. And as you can see, we do investments, planning, taxes. We work with a lot of business owners. And we have also, as Debbie pointed out at the beginning, been working with the credit union for a long time. And we've been nationally and locally ranked as one of the best financial advisors in the country. So I'm going to stop the screen share so you can see me a little bit better. And I'm going to take Mike's question and I'll see if there are any additional questions. And if there are, we'll take them. And if not, we'll wrap up and let you go on your way. So I'm going to read Michael's question because there's a lot of details in here and they're all highly relevant. So he's a member of the credit union. He says he's retired. He says he has a 401k that is very conservatively invested, but yet he's watched it drop in value. Luckily, he doesn't need to draw any of those 401k funds. He doesn't need to spend that money in his 401k right now. So he understands that he's only suffered paper losses, but he is concerned and he would like to learn about how to best protect his assets in period of volatility. So, couple things. First of all, Michael, thank you for the question. Secondly, I appreciate and thank you for pointing out that right now it's only a paper loss. So I always get a kick out of people who will be chatting with me and they'll be like, oh yeah, I remember 2007 and 2008, I lost so much money. And I always ask them, oh, well, why did you sell? And they look at me kind of confused and they say, well, what do you mean? Why did I sell? I didn't sell. And I said, so your account value went down in 2007 and 8. No question about that. I remember. Trust me, I remember. But I said, but you didn't sell. So then by like 2010, you were back up to where you were before. So you actually didn't lose any money. And people always say, well, yeah, okay, I guess you're right. I didn't lose money. So be careful about how you think about this. And again, I'm not trying to be cute or make people, feel silly or anything like that. I'm just trying to point out that it is a paper loss. And if you don't need the money and you're going to be invested for another, 2 to 5 years or longer, you're in all likelihood going to make this up and be ahead of the game. So you haven't really suffered a loss yet. You still have the same number of shares. They're just worth less. And the good news is that now when you're investing, like in your 403B, every 2 weeks when you get your paycheck, you're actually buying more shares. So when the market goes up, that will help you substantially to create even more wealth for yourself. But in terms of specifically answering Michael's questions, so the first thing I would recommend, based on everything you shared with me, you don't need the money and that you're concerned, but you're not freaking out, so to speak, is don't make any drastic changes. Don't go all the cash. Don't go all the bonds. Don't go all the stocks. Don't do all of anything. But maybe it's time to think about making some fine-tuning changes. So you could, I don't know exactly what your mix is because you didn't share that with me, but if you are not diversified between growth and value, you could do that. If you're not overly diversified between stocks and bonds, you could do that. There seems to be a fair amount of evidence, and we would be supporters of this concept, that the returns that you're going to get here domestically in the US will in all likelihood be greater than the returns you get overseas in the near term. So, if you have a significant amount of your assets invested internationally, maybe you want to bring those back home. Those are all some things that you could do. If you're in long-term bond funds, 30-year type treasury funds, I would shorten those up. So you're in a limited maturity or a shorter duration, as we call it, bond fund, which will be less prone to losing capital as interest rates rise than those longer term bond funds. So I do have a few more questions here, which is great. Let me kind of move on and take some of these questions. So Laura asked how much it costs for a consultation and what is the general cost for financial retirement planning at your business. So there is zero cost for a consultation, Laura. Thank you for the question. Not only is there no cost, but there is no obligation on your part. We do them virtually, we do them in person, and we just do them over the phone if that's easier for you. A great way to start is to simply get in touch with my office. There's a link on the credit union website, or you can just go to bwfa.com. Click the button for the initial consultation, let them know you came to one of our webinars and you want to have a conversation with Sandy, and I'll talk to you for 10 minutes or an hour. or something like that about your situation and what we do. And in all likelihood, you'll get a few more personal tips that I'm able to do in this format. And you'll learn about what it is that we do and if it's something that you want to avail yourself of. We do give a discount for services to credit union members, and the cost of service varies depending on what it is that you want to do. There can be literally no out-of-pocket cost for some services and some very reasonable costs for others. I'd rather go into that in detail with you when we talk. What is fee-only service? So fee-only service is where you work with a company that does not charge you commissions. So in other words, if you're working with like a broker at one of those big firms, I mentioned some of them earlier, in all likelihood, they're not fee only. So when they sell you a mutual fund, right? When they sell you a mutual fund, they get paid a commission to sell you that mutual fund. In fact, they might get more commission from selling you mutual fund A than mutual fund B. So which one do you think they're going to sell you? They're going to sell you mutual fund A because they make more money selling you that one. It may or may not be the best mutual fund for you, but they're not a fiduciary, so they're not obligated to do what's best for you. And they get paid on commission, and I don't blame them. They're human beings. They're trying to make a living. They're going to sell you the fund they get paid the most commission on. When you work with a fee-only fiduciary, we are required by law to do what is best for you at all times. The services that we provide you pay us no commissions, and the fees that you pay are all flat, typically percentage fees stated in writing up front, typically around a 1% fee. It's not dissimilar to what you do at Transamerica or T. Rowe Price or Vanguard or Fidelity. All these companies have fees that they charge. Nobody is doing this out of the goodness of their heart for free. What's different about a fee-only fiduciary is that, again, we're legally obligated to do what's best for you at all times, and we state everything in writing up front so that you know exactly what the costs are. I would also make a couple other quick comments about fees while we're talking about them. While they are important, and you should know exactly what the costs are, and ultimately you are paying those fees, whether they're deducted straight from your investments like they do at Transamerica and Vanguard and T. Rowe Price and Fidelity, or whether it's a commission that you're paying to some broker. You should know what you're paying, no question about that. But put it in perspective with the services that you are being provided. So again, just working on the 1% rate, if you're paying me a 1% fee, am I providing you with expertise that is driving the return on your investments to be greater than a 1% rate of return? And if the answer to that is yes, well, then I'm paying for myself and you're getting more for that 1% fee. So I wanted to give you some perspective. Here's another big tip for you, and I really am wrapping up in the next couple minutes. Is your fee charge, this is another question from Sandra, is your fee charge per consultation? We already talked about that, no charge, or is it based on types of assistance? For example, I want to discuss tax, relevant living costs. Would there be 2 fees charged or 1 fee? So lots of questions about fees. Nobody's asking me about what services we provide. You're only asking me about what they cost. And while I appreciate that as a concern, and it is reasonable of you to ask that, where I was going with my last comment is don't forget to ask about the services, right? Like sometimes I shop at Walmart because I want the cheapest price on something that I'm buying. But other times I buy things, I don't go to Walmart because I don't want the cheapest version of it. I'm willing to pay a little bit extra. So when you work with an investment advisor, if you want it to be cheap, great, you can get that. But what you really want is somebody who's going to provide you best interest and depth of services so that you're getting value for what you're paying for. That is something that's important. So let me close on this value tip. In these volatile markets, one of the things that you see a lot of is people that sell annuities out there screaming from the rooftops that annuities are the answer to everything and that you can never lose money and blah, 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 blah. Don't believe it. It may be a lot of hype and not a lot of reality. And in really volatile markets like this, annuity salespeople prey on the emotions of investors with telling you all about these wonderful annuities that, again, will never lose money and they'll guarantee this and they'll guarantee that. I have never seen an annuity that really made sense in the long run. They're expensive and they generally tend to handicap. You can't get your money out without paying penalties. They're very expensive. You ask all these questions about fees. Go look at what the fees are in annuities. My fee runs, as I said, about 1% a year, depending exactly on how much you invest with us and what services you're using. Annuities routinely run 3 to 5% a year. So to finish up, in summary, there's no cost or obligation for you to have a conversation with me. Pick up the phone, go to our website, schedule a 15-minute phone conversation, and I'll answer all your questions about fees and services so you can make an educated decision as to whether I might be a good fit for you or maybe I'm not, but then you'll know. I think that would be the best bet for most of you that were asking those types of questions. So while my clock still says 1:09 and I can look you in the eye and say, hey, I'm signing off without using the full 1:15 hour, I'm going to do so. Debbie, if there's anything I need to know, please come back on and tell me. If not, I'm going to leave the webinar. I want to thank you all again for coming. Encourage you all to stay safe and stay healthy and stay happy, and let us know if we can be of help to you. I hope to see you at Social Security and Retirement 101. I believe the dates for that are August 3rd and August 31st, but you can double check on the credit union website. And again, thanks for coming. Bye now.
Thank you all.